All right, so this is Shane Handy with the Rational Trader, and it is the 7th. We're doing a weekly update here. We have actually a specific agenda here that we have a lot to go through today. So we're gonna talk about really what I'm after is making sure that you're clear on the interdependencies of the different pieces of this system, and kind of what the roadmap is, to make it a little bit easier to deal with the different pieces working together. And then we're going to do a little bit of the same thing with the models. So there's been a fair amount of work here the last few days, actually, looking at models and model architectures and what that roadmap looks like. Okay. And then we're going to do a review of the current model versus the current conditions. And there's some decisions to make about, sort of what model to use going forward given the volatility. And then this week's update is fairly big, so we're going to talk about that as well. So let's get started here. So this is the chart, a view you've probably seen quite a bit. We've got these four pieces here. There's the Sierra chart, custom study, the chart books, the machine learning system, and the models. And those four separate pieces are intended to update independently, okay? Specifically, you expect a new machine learning model every week that includes the data from the most recent week in its learning, okay? This is what we've been doing. It's not quite as separate as this, as I'd like, okay? It actually looks more like this when you start analyzing kind of what depends on what, and if I change this, what happens to that. All right, and so the orange box in the screen here it's not the model like it is here. Here I'm actually talking about the model itself is changing because it's getting new data. In this case, we're taking a little bit of a bigger view, and it's the model architecture. So not just every week we add new data to the existing architecture and then publish that and everything, and you install that and everything works as it should. But I can change that architecture, all right. And in fact, it's intended that I do that to improve things as we move forward. And the problem is that an architecture change has an impact on the custom study that's installed in the DLL that you download when you launch Sierra Chart, and also the server. Okay, that custom study, it's called TRTML Predict. It's installed in the chart book. It has some settings, and the machine learning server has a configuration file, which is basically the same thing. It's information that the system uses to understand what to do, or what you want it to do, how you want it to behave. And you can see the problem here. If anything's touching anything else, it means that if it changes, everything else has to change. And so if I change the model architecture, we're currently on Rev 49. If I change that architecture, both the DLL and the machine learning server have to change, right? And that's a pain. All right, we'd like to get to a point where I can change that architecture and not require those other pieces to change. All right, this is what's happening this week, actually, as we're moving to eliminate this tightly coupled interdependency. Okay, so what we're doing this week, tomorrow, is I've made changes to the DLL such that it's no longer tied at all to the architecture. Okay, so any change I make to the architecture does not require a DLL change, and vice versa. Okay, the machine learning server, there's still some stuff in there that will be affected if there's a model architecture change. In some cases, I'm not quite completely independent yet, but I'm headed in that direction. I want to get to a point where I don't have to worry about, gosh, if I make this change in the architecture, then everyone's going to have to update their servers. I want to get to a point where that's not the case. All right, so we're headed there. And that would look, that would look like this, where any changes that need to be made in the server or the custom study because of a model architecture change, you would just make as part of your settings. So you don't have to reinstall everything. You might have to make a settings change or a configuration file change, but that's it. Okay, so this is where we're headed. Tomorrow we're getting to this point. All right, you're going to have to install a new server, a new DLL will download, and that has to be sort of carefully coordinated. And there's new chart books actually as well because the custom study changed. Okay, but we're going in the future. There'll be another change to the server, such that I won't have to make more changes whenever I change the model architecture. All right, this is important because we want to be able to incrementally improve the models as we sort of glean more data, more information about how they behave, and as the environment changes. Okay, so that is the review of sort of how these pieces fit together and where we're headed. So we're headed to a point where I can make changes to any one of these, and it doesn't require reinstallation of the others. Okay, we're just not there yet. This will be tomorrow will be the first major step in that direction. Okay, doesn't look like there's any questions here. So if we look at the way that we're currently set up with models and market behavior, this would be a reasonable representation. There is a machine learning server. It has 4 models. Currently, yours only has 3. All right, tomorrow you'll have the 4th one, the breakout model. And when we see a breakout behavior, we call the breakout model and make a prediction. When we see a pullback short behavior, we call the pullback short model to get a prediction. Okay. There's another way though that we've been kind of chatting about, and just this week I got to a point where it's now we need to talk about it because there's a potential change coming. The other way to do this is, instead of separate models like this, you just have a single model. Okay, and so instead of I've got a breakout behavior, okay, call the machine learning server, tell it to give me a breakout prediction using the breakout model. I have just a single model. It's a complete model that sort of encompasses all these different behaviors. And when I see that behavior in the market, call the machine learning server and get a prediction from just that model. Okay, this has a lot of advantages actually. The biggest advantage is that there's a lot more data now that you can use to train the system on. All right, so this method here, it's aesthetically pleasing in that, okay, if the market's breaking out, I can exactly model that behavior and get a prediction. And the problem is that there's actually not that much data, not relative to what a machine learning system needs. And so when I switch from training a system on separate behaviors like this, separate models, one for each behavior, to this, I get at least 10 times more data. And that makes the models a lot more resilient. Okay. And so it wasn't clear to me that I could do this at the beginning, which is why I didn't just start that way. All right. I just completed training a model. We're going to go over this in a lot of detail in a minute, but this week I completed training a model with a new architecture that is a single model that works regardless of what the behavior is. Okay, and so the reason that this is important is that if you think about what that means in the future, we can rearrange this diagram so that it looks like this now. Okay, so this is the same behavior, the same exact thing. We've got the behaviors on the right. When they happen, they call the machine learning server for a prediction. It uses its model and sends back the prediction, and then off it goes. But if you can change it to this view of the architecture of the system, the system or the system design, all right, you very quickly can see that you could move to the next obvious step is something like this, where any user-defined behavior, that you define, you can use to then just call the machine learning server and have it make your prediction. And this works because you're using a model that says, I don't care what the behavior is. I'm looking at every single bar. And based upon every single bar, this is what I've learned about how the market behaves given the order flow that's present at that time. Okay? I've just gotten this complete model to work. And so this is why we're talking about it. What this requires is that this vertical gray bar on the right needs a little work, because you have to define, well, how would any user tell the system that I want a prediction? Okay, so let's say you want to do you'd like to see predictions on pullbacks to the 20-period moving average. All right, then you're going to set up your system to define when that happens, and when that happens, you're going to call for a prediction right then. Okay. The same, whatever it happens to be, anything that you can define, you can say at this point in time, give me a prediction, and then the system will respond accordingly with the trained information about what the order flow looks at that time, whether you should get long, get short, or do nothing. Okay, so this is where we're headed here. I very clearly can see that this is. I've already seen members changing, adding things to the system, changing the adding filters, things like that. There's a better way. There's a better way in that rather than you depend on my view of what is an important behavior in the market, you just define it yourself and can call the system at any time. Okay, so I don't know how long we are from this, but that's clearly the path we're on, and the reason is that we are very clearly headed to this. All right, and we need to talk about that now. All right, instead of 4 separate models, switching to a single model, and it's merely a question of timing. Do we do that now? Do we do it immediately, or do we wait it out a bit? Okay. Would it be possible to pick and choose any particular behaviors only with a complete model? Yes, that's the idea. The idea is that you define it. Whatever condition you want to see, you just call the machine learning server when that condition happens. You're now responsible for doing that, right? So if you want, I don't know, moving average crossovers, when it crosses over and the oscillator is this or that, then you say, okay, when that happens, give me a prediction, and the system will provide it, right? As opposed to what happens now, where what happens now is there are very specifically defined behaviors that I've decided on that the system uses and responds to. Okay, so what we're doing is we're divorcing in the same way that we're separating out the interdependencies of the different pieces of the system. We're now separating out the behavior from the models. Okay, so that you can do any behavior you want. All right, and you just get a prediction because the model's using every single bar. It's not using only specific bars that happen at specific times in the market. It's using every single bar. Okay, and because of that, because it's using every single bar, it can respond to a request for a prediction on any single bar. Okay, and so your job then becomes, okay, if you want, your job is, okay, I like this particular method of trading, and this purple bar has to be defined so that you can tell the system, okay, when this condition occurs, give me predictions. All right, and that will happen, and then you can test it to see how well that method works for you. Hey, Bill. Okay, so Bill is asking, are you saying that perhaps we could eventually input our own alert conditions for learning and auto trading? You can input your own alert conditions to get a prediction. Okay, the learning has already happened. The system learns. The system doesn't learn based on what your anything that you do. The system learns based on what actually happened in the market. Okay, this is why what you would then do is combine your understanding of what you think is going to happen at this point in time, at this behavior, with what actually happens. Okay, because when the machine learning system is training, it knows what actually happened because it's past. And so what I do, just going back to basic machine learning theory, I give it the data, but not what happened, and it uses that data to learn how to predict what happened. And if I do that for every single bar, then you can go find your alert condition or your behavior and test to see, okay, give me a prediction when this behavior happens, and now you'll know. Because the system, the machine learning system has defined what the order flow is, all right? And so it really becomes a question of, one, is your particular alert useful over time? Is it reliable? All right. And then the other piece that is part of that is, well, is the view of the order flow that I'm giving to the machine learning system appropriate? Okay. We're going to go over some of that in just a minute on my behaviors, but you have the ability then to say, all right, for this behavior, give me predictions, and then test it out and see how well it works or not. Okay, so the idea is that the blue bubble up there is anything that you can get Sierra chart to trigger on is something that you would be able to send to the machine learning system to get a prediction. And it doesn't matter what I as the machine learning system, I don't care what that behavior is. I already know what happened, and I'm trained on what's happened. I'm trained on the order flow, and I'll just give you a prediction based on what I see in the order flow, based on the last n years of data that I've been trained on. I'm reading questions here. Okay, so Brian says, is this an easier setup if you want to only trade within X ticks of a new high, a new low, or yesterday's close, etc., or trade it around these qualifying market setups? It's right now you can't do what you're describing, Brian, because you're locked into the kind of behaviors that I've specified, right? Breakout, turn, pullback. But if you can tell when we get here, all right, if you can tell Sierra chart that I only want to look at breakouts of new highs, as long as you can define that in a formula in Sierra chart, you'll be able to just trade. You'll be able to get predictions just for that, okay? Because the system knows what happened, or rather, it knows what happened in the past, okay? It knows what that order flow looks like. It'll find the pattern of order flow that matches the current bar, and then what it does is it basically becomes a system it's a generic prediction system, regardless of what I think is a good trade setup. So if you can define the trade setup in a way that is mechanical or deterministic, I should say, then you can get predictions off that trade setup. Okay. Right now you can't. Right now you can only get predictions off of how I've defined what a pullback looks like, how I've defined what a turn looks like. Okay. So it basically just opens the system up to you for you to use however you want. Okay. I'm actually fairly excited about that because just in the 4 or 5 weeks here that I've been working with other people now. It's not just me in my opera cocoon developing the system. There's been lots of really interesting things going back and forth that I can't do. I don't have time. I don't have time to investigate that. And you can't either because you're kind of locked in to the specific behaviors that I've defined. Okay. And so what'll end up happening is What I'll provide is this, the orange piece and the yellow piece and the purple piece, and I'll have these, my chart books that have trade setups that are the green bubbles, and you can use them or not, or just make your own or add to it, however you want to do it. Okay. It became very clear to me that there are a zillion ideas out there, and we already know this about trading, is that there's so many different ways to skin this cat. Lots of different ideas about how people want to approach it. And if I do it this way, okay, you can get a prediction based on any condition that you can define. I've already provided how I define pullbacks, breakouts, etc., but we can go over it again. Okay, so Russell's got a great question here. It says long or short based on what? All right, and so currently, the way the NASDAQ is trained, it's based on, from this bar, did you go 30 ticks in one direction versus 10 ticks in another? Okay. That's how it's trained. And in the ES, it's 12 versus 4. So there's a 1-to-3 risk to reward ratio, basically, in the training system. Very important to understand this. All right. Look, I'm just waiting to see if other questions come in. Okay, so now let's talk about the current model we're using, which is Rev 49. It uses what this means is the revision of a model is the data that's given to it, as well as the machine learning architecture that's used. Okay, so you can actually see the data that's given to it if you look at the custom study. It's a pain, and it's a real pain for you to untangle what it is, but you can see it because we define in that study what to send. All right. And I lost my thought. Give me just a second here. Oh, okay. So the other piece of the model is the architecture itself, which is a function of how many layers it has, what kind of machine learning architecture it is, and how many nodes are used. This is a little too technical for today's discussion. But as I rev that architecture, one of the things we talked about earlier was making sure that I can do that without requiring reinstallations of servers and things like that. The dilemma that we're facing right now is the initial release that we've been working with, which is Rev 49. I now have more data that's being collected that I've been wanting to get, and I'm starting to run tests on with new models. Okay, but the current conditions are so volatile that I was actually somewhat doubtful, starting to doubt myself. My gosh, is this actually going to work? Because the conditions are so ugly right now that the system performance has not been very good. And so what I noticed was that as the market here has started to settle down, it's kind of going back to the results I was seeing during development. And so what happened is we went live, the markets had gone berserk, and I was working through different adjustments to make to kind of deal with that volatility. And then as the market it's started to settle down a bit, it's not quite back to whatever that new normal is going to be, but clearly it is getting better. And I noticed that because I've been adding filters and doing adjustments and things like that, trying to deal with the volatility. And in the meantime, I've got members who are just using the system sort of as it was defined, and starting last week, it started to perform pretty well. even just using the regular system. And so what I did, so I was dealing with that doubt. Gosh, did I make some major error somewhere? Did I make a big mistake? And just not understand how all this works. And so what I did is I went and I took this complete model concept we've been discussing, and I took the results of some of the analysis that I've done that you can see in the daily videos from this past week, and I built a model, a complete model for the NASDAQ for the 2017 contracts. So HMUZ for 17, okay, which ends on December 7th or 8th of last year. And then I tested that model on the H contract for 2018, which starts the next day, like December 8th or something, okay? And what I did is the first test is right here. All right, this is the actual trade activity log from Sierra chart. You can see it starts from 12/8. Okay, and so this is the Rev 55, which means it's the current Rev we've been using, plus the information about the most recent two waves or two peaks of waves. So the recent highs and lows of the last two waves. That's discussed in the daily videos this week. Okay, a complete model, so a single model for all behaviors. And this is no filters, just as I'd been developing the system. Okay, and what I wanted to do is I wanted to sort of re-verify. Okay, yeah, this does work, absent crazy volatility. All right, and so the idea was build a model, a complete model for the last year, and then test it on, basically it works out to be most of December and all of January, okay, because February 2nd is when the wheels fell off the bus. So that's what you see here. This first one here is exactly what I've been doing, no filters, nothing, just when you see that behavior, make a prediction, and I used 80 tick targets. Okay, so 80 tick targets trail by 20 after you get 20. The exact trade management that I'm using in the live trading today. Okay, and what we see here is this is the P&L for the day. Let's make this some color here. That's the P&L for the day, and then this is the running P&L. Okay, so this is the one we're going to be focusing on. That yellow might be hard to see. Okay. And what you see here is in December, there's a little bit of an ugly stretch right there, but for the most part, not too bad. You come out of December basically flat. January, you start making you start doing pretty well. Okay, you start building up, and then this day right here is where I'd call the end. So let's make that orange or something. Okay, because that's the day where everything, the market just went berserk. And very clearly you can actually see that in the data here, in the daily results since the volatility went through the roof. It's just nothing but negatives. Okay, but up to that point in a 2-month period of time, 22.55 on a $5,000 account. Okay, so that's a little more than 40%. All right, certainly good, certainly acceptable. All right, so not in any way, okay, Shane, you were just completely wrong as you developed this. Volatility is another issue. We're going to talk about that in a minute. All right, this is what I did with no filtering at all. I see that behavior, give me a prediction, and then execute that trade. It's set for the same settings we have now, which is a $115 loss. You stop. So your max loss is like 160, and then the max gain was set at I don't remember now, a lot, like 1,000 or something. Yeah. So basically, if you got 20% of your account, just stop. Otherwise, just keep trading. Okay. How many trades per day, Dave? I can actually give you these spreadsheets so you can see that, but you can see the number of trades is very reasonable. These are not in any way outrageous. All right. None of this is nasty. It's not like recently when the volatility is so high, the market just went crazy. All right, so 9. These low ones are the days where you just basically got whacked pretty quick. All right, 9, 3, 13, 12, 10. This is all reasonable. All right, this is way more trades than I ever take as a discretionary trader, but as a machine, this is not in any way, I think, unreasonable. Particularly since I'm not doing any effort, right? I'm just letting it go. Commissions are not included in this discussion. This is just gross and net proceeds from the trades themselves. Okay, so now, having said that, we've actually done some interesting things together as a group related to filtering. So things like when the markets are sideways, don't trade, and other things. I've been working with Russ on some oscillators. Okay, so let's look at the next test I ran. Okay, so basically this test here validated that I haven't wasted a year of my life. Okay. Where's the next one here? Here's no filters. It's the same test again, but this time with a 40 tick target instead of 80. All right. So instead of you place the trade, you set your target out at 80 ticks, and then you just start trailing by 20 when you get to 20. All right. Here we set the target to 40. All right. Here's the P&L column. This is the running column. All right, so let's make that green. Oops. Thank you, Microsoft. All right. And so it ultimately, we're just going to look at that one right there. All right. That's the ending value. All right. And so what I see there is a really big difference. All right. So very clearly, don't limit your upside is the message. Very objective analysis. Philosophically, I'm very pleased because that's how I view the market. Limit your losses, don't limit your upside. You can see a huge difference here. That's 3 times the amount if you just set it to 80 ticks and let it go. All right. There's no human intervention at all in these tests. This is all just Sierra chart replay. Okay, so Bill is asking. There's a couple great questions here. So let's do Brian first since he was in first. How do you know ahead of time the volatility will change and stay that way? So Brian, it's actually not that difficult at all. In the NASDAQ, we look at the overnight range, and in the past there was a very clear delineation between 40-point overnight range, 50-point overnight range, 60-point overnight range, and it was very. There's actually up on the site. You can still go get it. There's an NQ volatility assessment guide, and I need one for the machine learning system. It's very simple. All right. So the simplest answer is when it gets volatile, don't trade, don't run the system. That's the simple answer. All right. And so it's not an answer people want to hear because they want to make money all the time, right? They want to at least have the opportunity to make money all the time. Even worse, they see the big moves and they get stars in their eyes and they get greedy and want to make that money. Not really internalizing that it's far more unpredictable under those conditions. All right, it's like the surfer who can handle 10-foot waves and then 40-foot waves come in, and instead of heading to shore, he tries to surf it and ends up in the hospital or the morgue. Okay. So it becomes it's not that hard is my point, Brian. You're not trying to make a decision every day because the market goes through periods where it's super volatile and then it'll settle back down and then it'll go super volatile again and then it'll settle back, and then it's just a matter of make that decision on the weekend and then follow your plan for that week. It's really simple. What you need to do is simple. Doing it can be hard, All right, that's something I've been teaching for years. But define a set of rules and just follow them. Okay, and in this case, it's really not that difficult to figure out. The markets are too volatile to trade. All right, what you'll discover if you watch the markets a lot is that you get a feel for I don't want to do this. This is too scary. This is too difficult. We have to relearn that a little bit because now the machine can do things better than we can in some ways, and so there's some adjustment is needed there. But certainly the machine can trade volatility that I can't. But when it gets too crazy, it's just stupid to do it. The unpredictability is too high. Okay, I'm working down questions here. Bill says, were you at all interested in what the results would have been if you had not stopped trading after the loss limits were hit? Yes, I'm very interested in that. Because one of the questions is, well, if I just cut my size in half and take more shots at the basket, can I trade that volatility? And so, Bill, I tested that in the volatile conditions. What I didn't test that in the non-volatile conditions. So I need to do that because I'm really interested in understanding. This is taking 1% risk per trade on a $5,000 account. What if I take 1% risk per trade? 0.5% risk per trade on a $10,000 account, but still am willing to risk 3% a day. So in other words, I get 6 tries at the basket instead of 3. All right. So that's a test that needs to be done. I really want to know the answer. As a human trading, the lower your percent risk per trade, the better, because the less the intensity of the emotional reaction you're having to that risk. All right, but the machine doesn't care, so it's just a matter of let's work out the math. Did you say you used an 80 tick profit and a 20 tick stop loss? No, that's not what I said, Randy. I'm using the current trade parameters that I have now, which is a 10 tick stop loss. At 10 ticks, move to -5. Okay. And then at 20, start trailing by 20. Okay. But a hard target of 80. Okay. And so basically, I used to just trade for 40 ticks and discovered that most people have trouble even holding for that. Here you can very clearly see there's a lot of times the markets move more than 40 ticks and don't pull back 20 ticks while that's happening, because that's 3 times the game. All right, so it's very, very clear. Set it to 80 ticks and let it go. Sometimes you're going to be upset because you would have made more if you took your 40 tick gain, but across a 2-month period, this is statistically valid now. Across this period, it's very clear. All right, just let it go. In your experience, does the NQ have better days to trade? I don't think so, but you actually can use the replay to see that, because in the trade activity log, they have that built in somewhere. Period trade stats. Yeah, you can somewhere you can say Mondays, Tuesdays, Wednesdays, and look at it. So you could run the replay yourself, Philip, and then see. I've never not traded because it's Monday. Randy, so are you clear on the trade management? Let me just make sure, because your question, I'm just looking at your next question. Okay. So, and then Larry, I think we've covered this already. One of the ways that in the past I've gauged volatility is how big was the overnight move. Okay. Brian, Brian, I'm just going to read your question because I don't quite understand it. Can you trade the system to high overnight range and let the system switch at market open depending on the overnight range between the high vol and low vol system? I don't understand what you're asking. With the new server architecture, you can have different chart books running at the same time with different sets of parameters. And the only question is, will Sierra chart be upset because you tried to place a long when you're short? The machine learning system will no longer care. If you have a chart book set up that's for cash session start to the morning and you've got another one running from overnight with different parameters, you can do all that. I'm not sure I'm answering your question though, Brian. I'm not done here though. Let's continue, because I did some more testing here, and I want to. It really addresses sort of the power of community. All right. So this was the one on the left was validating that Shane didn't waste a year of his life. The next one was, okay, well, what if you try to just take a smaller bite out of the market? All right. And we can see clearly that you're better off just letting it run. But what we did as we saw this volatility happen was we started talking about different ways to filter out times when it's really not that smart. All right. And that actually drove some modeling work on my end to give the system more information about, is it moving sideways or not. So there was one incremental improvement already in Rev 49. There's another one in Rev 55, but there's also an external one that we can apply that makes sense to me to keep out of the machine learning system. Just let you, the user, decide how aggressive or conservative you want to be. And so what we do is, one of those filters was just take a standard moving average and look at its slope. And if the slope is too flat, don't trade. Okay? And so that is what we call the noise filter. That's actually built into the system. It's right here. This is a noise filter of 4. What's actually going on there is it says, here's an 89 period moving average, and here's the angle of that moving average, and if that number is less than 4 or greater than -4, if it's between those values, the markets are sideways, don't trade them. Don't allow the trade to go off. All right, that's the spreadsheet's doing that. Note that you can define that all you want. You can change that. You can change that moving average. You can change the amount of slope you're willing to trade or not trade. Okay, but what we've been using is 6 and 4 have been the two candidates in the current volatility. All right, and so what I did is, because of discussions I had with Daniel over the week, I took the trade that I ran right here, this trade, okay, on the left, where that's a very nice profit across 2 months, and I said, okay, what if I apply the noise filter? What happens? Do I keep myself out of trades that would lose money, or do I prevent myself from getting into good trades? What happens? What's the overall result? Okay, so that is right here. Rev 55 NF4 only. That's here. All right, so our green. Let me get this other spreadsheet out of the way. The green. Let's make this green so we can easily compare them. Okay, so here's the basically test 1, but with a filter, a noise filter. All right, and what you see very clearly is just a spectacular number. Okay, so you can look at that day by day, and you can see what's happening. In fact, I can package these up and make them available for download if you guys want, or just email them out to the members. A very dramatic difference. So very clearly to me, that mechanism, which some of you really dislike, all right, has a huge positive impact on the overall profitability of the system. Okay, that's 80% in 2 months. That's a ridiculous return. Okay, now speaking to some of you that hate this idea of this way of filtering out sideways action, I also ran the test that uses the oscillator that we've been working with. So over the same period of time, we have you've seen. Let me see. Where is the? Not that one. This one. So you've seen this oscillator here, this blue and pink line. All right, this is based on some discussions with Russ. about only trading in the direction of this oscillator. So if you get a trade that is along while the oscillator is pointing down, then you would filter that out. Okay. So I did a test, the same test. All right. I removed the noise filter. I just set that to 0. And I said, okay, do the same test with just trading in the direction of that oscillator. Okay. And the results were here. Let me get this other stuff out of the way. Here are those results. This is, it should say MTF, not NTF. MTF is multi-time frame. All right, and so that's these results. So this is test number 1 again, but using this oscillator as a filter instead of the moving average noise filter. Okay, so let's make this green so it's easy to compare. And what you see is, here's the second. It's basically equivalent to a 40 tick target test. It's dramatically worse than no filter at all, and even way worse than using the noise filter, the moving average noise filter. So I'm sorry, Russ. Objectively speaking, the noise filter, that as we've defined it, works much better. Okay, so that's kind of where we stand in terms of, okay, under normal conditions, however you define normal, there's very clearly an edge that we have by using machine learning. All right, and particularly if we apply an extra filter over here to try to avoid choppy markets. And I got to stop and look at questions. I'm sorry. Okay, that's not a question. It's just a comment. Okay, and where we're at is, yes, there's very clearly an edge here that the machine learning gives us. There's no question in mind. As long as you can execute the system every morning like you're supposed to, turn it on and let it do its job. Don't interfere with it. Okay, but we've got to deal with this volatility. Okay, or rather, we need to be able to identify the volatility and just stay the hell away. It's one of the two. Okay, so to date, I haven't found a clean way to deal with that volatility other than either drastically reducing the trades I'm willing to take, like only take breakouts, or cut your size in half, or cut it by fourths, something like that. But basically, Russ is asking about the number of trades. Let's total them up. So between the second and the beginning here, that sum is 126, and then the noise filter one, number of trades, 231, about twice as many for 8 times the gain. Is that right? 5 times the gain. All right, so it's not clear to me yet what to do about the volatility other than stand aside. Okay, hold on just a moment, please. That's just my phone alarm. But what I have learned from this exercise is I'm on the right path. All right, and whether I can or can't deal with mega volatility is somewhat immaterial. I don't want it to derail me is the point here. All right, so the question in front of us, this group of people, is there's an update coming out tomorrow. Let me get back to my agenda here to make sure I'm on. Does the noise filter only take trades in a certain direction or both directions? Bob, the noise filter just says if the slope is too flat, don't take the trade regardless of the direction. There's no directional input in that choice. It's just it looks too sideways, don't take any trade. Okay. The parameter on the noise filter is it's an 89 period moving average with, well, here, let's just look. It's an 89 period moving average with, actually, it's not in that one. It's this moving average here, okay, which is set to 89. Okay, let's just unhide it. And then this study angle, which you see down here, this is the angle of that moving average. All right, so this is set to moving average, okay. So those are the parameters. And so what we're saying is in the spreadsheet, you can tell it, okay, I have to be outside of this window in order to take the trade. All right, so it's now confusing because the colors are the same. Hold on. Let me take the oscillator off. So the oscillator is going to be hidden now. And so now it's just looking at this moving average, and it says if the angle of that average is greater than 4, go ahead and take a trade, regardless of direction, short or long, it doesn't matter. All right. But if it's in between, then it's considered too sideways to trade. Just stay out. Okay. This was done. Oh, great question, Larry. All of these tests were done with the moderately aggressive set of trades plus breakouts. So not super aggressive and not conservative. The moderate plus breakouts. Okay. That's what those tests were done on. A very interesting set of tests would be, well, what about breakouts only, right? What about, anyway, there's a lot you could do there. There's a lot of toys you can play with. You have a big, really interesting dials you could try to tweak one way or the other. The problem is that Sierra chart replays just take friggin' forever. It takes like 4 or 5 hours to run 3 months of data. And I need, on my list in big black letters, is write a program to do that for me, because I'm telling you, the very simple version I had of doing that test took seconds to process 3 months of data. Seconds. I need to make that program a little bit more complicated. So I'm going to do that, because I can't stand waiting that long to test an idea. Okay, so where's my agenda? How does the machine learn from its mistakes? It doesn't, Michael. What happens is, well, that's not true either. So if the machine makes a prediction today or yesterday, and it turned out that prediction was not good, there's no input into the system that says, hey, you predicted this and it was wrong, learn from that. That's not what happens. What happens is I give the data to the system every week of what actually happened. And so it now sees that bar and knows what happened, and then it learns that pattern of order flow. So the next time that pattern of order flow shows up, it's going to make a different prediction. And you've seen that yourself, Michael, because when you take today, the model you're going to get tomorrow, when you take it and run it against last week, suddenly it's going to perform perfectly, right? Really well, because it's learned that data. Okay, but you don't quite have it correct in your head what's happening. We don't look at the predictions we made and say that was wrong, learn from that. We just give the data about what actually happened to the machine, and it can now see what happened, and it learns from that. Okay. What speed do you run on? I use 200,000, and the replay takes about 40 minutes to do 2 months. I'm using, I'm not sure. I didn't see it go any faster, actually. I'm using 1920, and I'm doing multiple at a time, so I'm also stress testing the server. So it's possible I'm just being foolish and should just, crank this up to some huge number. At the same time, you have to remember there's it's not just Sierra chart internally talking to itself. Every bar, it's sending a message to the server. The server is doing something. It's got to send it back. So I was being careful. So in Sierra chart's defense, there is an extra element here. That's what the training is, Michael. Yes. Every week, I take last week's model and I load it in and say, here, start from this point. And then I take the entire set of data that I have and I add last week's to it. And I give it that entire set to the machine learning system. And I say, train on this data. And so because it's starting off at it's initialized at a point that's fairly advanced, it doesn't take very long now to incorporate last week's behavior in it. Okay. Al, everything's up on YouTube. Okay, and this will go up later today. If you don't remember how to get there, let's just real quick, we can show you. If you just go to the Rational Trader site and you just go to daily videos, it's going to take you to the site on YouTube. It can be a little hard to find it on YouTube. If you type in the Rational Trader, it's a new enough channel that it doesn't necessarily float to the top of the list. But nonetheless, if you just go there, and what you want is you want to go to playlists, and in playlists there's this artificial intelligence and machine learning section, which is the introductory webinar, and then all of these tutorials, overviews and tutorials. So this is the fourth one. There's three. The last three are already up there. Okay. All right. We got to talk about tomorrow. Let me get back to my agenda. Make sure I covered everything, because I got some questions here for the group. System overview, dependencies, the models and the roadmap. So we just did the current model analysis versus the current conditions. All right, so this week you're going to get a new server because I'm adding the breakout behavior. Okay, that's in the server. There's a new DLL that will be uploaded. The timing is not quite defined yet. I'm still working it out with the programmer. Basically, if you get the new server and you try to run it with the old DLL, it's going to complain, and vice versa. If you have the new DLL on the old server, it's going to complain. All your predicted actions will be zero, do nothing. Okay. There's a new chart book that'll be coming out because there's a new server and because there's a new DLL. So there's an extra setting now that has to be set. So new chart books are coming out. And they'll include sort of everything I've been doing. The model is what we have to talk about as a group here. Currently, you're on Rev 49, and that's what we've been using. All the testing that we just went over that uses a single model was done on Rev 55. So there's two decisions that we need to make here. All right. The first is, do we want to stick with separate models for separate behaviors? All right, we can do that again this week. Or do we want to switch to a single model? We will eventually be going to a single model. That is going to happen. I can see that now. Just the results of these tests demonstrated very clearly to me that that's the proper way to go. And it fits nicely into that roadmap we discussed. But for tomorrow, the question is, do we want single model, which means Rev 55 also, or do we want to stay with what we've been using, which is Rev 49 and separate models? Okay, I have an opinion, but I'd like to hear what the group has to say. Okay, keep going. That's 4 people. There's one more than that in the room. All right, so a couple questions came in. Let's answer those questions. Michael, we were talking about the use of the noise filter in normal conditions, all right? and they very, very clearly showed that the current method that we're using is effective. Okay, so the number here on the left, 2255, is the running P&L from December 8th through February 2nd. All right, using no filters at all. And I lost it. Here it is. And if we use a noise filter of 4 using the current method, we basically double that number. So it's very clearly beneficial. Okay, the problem is not choppy markets. The problem is the volatility. Okay, so the choppy market or the sideways market action, we very clearly have an answer for. We don't necessarily have an answer for the mega volatility right now. All right. Pros and cons of each. Okay, so most of you are saying go to Rev 55 in a single model. There's one dissenting opinion, and then there's one question. The pros and cons of each. So we are eventually going to a single model. I can see that. So that's something to think about. Whether it's this week or next month, that's going to happen. It's very clear to me that the use of more data, combined with the fact that I deepened the model, produces an output that is pretty beneficial. I haven't seen, or rather, I can't really say what the pros and cons are with definitively, because I didn't run a Rev 49 test on this same period of time with these same parameters. That would be how I would answer that question, Philip. All right, that's the objective way to do it. But what I have in front of me is a single model using Rev 55 with some pretty good results. All right, so I'm comfortable with that. There's still work to do there, but I'm comfortable doing it. It's harder for me to go to the single model now because I've got to make some additional changes to the server. It's not that big a deal, but that really shouldn't affect our answer here. What's the pro for Rev 49 is that it's known. Okay, that would be the con for Rev 55 is that it's new. We haven't used it in real trading conditions. I think that the use of real trading conditions is almost shouldn't be a factor in the decision because the markets have been so volatile that my basic approach, my basic advice right now, or my recommendation is don't trade it. It's too volatile. It's not worth it. And my task here is to go identify a quantifiable way to determine, okay, I am going to trade the system today or I'm not, or I am going to trade the system this week or I'm not. It's probably based on what I've done in the past, but it still needs to be done. Okay. Can some of you run Rev 49 and some run the newer version? It's too much work for me, Jeffrey, to support it. You don't have to update. You could just stay with what you've got. So you wouldn't have to update. That's how you'd stay on Rev 49. You'd be 1 week out of date on data. All right. The alternative is I create we could do that. I could create Rev 49 models and stick them up there. And then you could use those if you didn't want to change. That would work. Jeffrey, that's a good idea. So I could create Rev 49 models. You can use those if you want to. Separately, I'll create an installation package. Oh, crap, that's not going to work, Jeffrey. I'm sorry. The reason it won't work is that the custom DLL is going to download, and that has to be updated. And as soon as that DLL downloads, you have to be on the new server. Can you use Rev 49 models with the new server? You can. Okay, so here's what we can do. I can create Rev 49 models and stick them up there. And if you don't want to switch to 55, that's fine. There is an extra setting change you'll have to make. in order to use the old system, in order to use the old revs. It's not that difficult. It's reasonable. Yeah, Russ, I don't want to go there, man. But yeah, you're right. No, we haven't. I haven't looked at the P&L for the live account today because the volatility has been so ugly that it's just nasty. So did you come late, Dan? If you came late, just watch the recording. It'll catch up. It'll catch up. Okay, so what I'm hearing is that most people say switch to single model and go to Rev 55, and there's a handful of dissenters that want to stay on 49. Okay, and now they just lost one dissenter. All right, so most people are saying switch to 55. I think that's the right choice. Let's see, is it Jeffrey? Jeffrey, I'll see what I can do to make to accommodate you. If it's too hard, then I'm sorry. You're going to get dragged along, kicking and screaming with the rest of us. All right. So that decision's made. Now I have a fair amount of work to do because I've got to get the installation package built and then tested. It's the testing part that takes a while, so that we know that it works. And then we also have to coordinate the download of the DLL. So basically, when we upload it to SC, that's when you've got to be on the new server. So just keep in mind, if you start running your server and it starts rejecting, it'll say something like expected feature list doesn't match. The feature list that was sent doesn't match what's expected. That means you're out of sync. Okay. It won't give you bad predictions. It just won't give you any. Okay. So we always err on the side of do nothing. Anytime there's any kind of error internally, the answer is the return 0, which means do nothing. Okay. This is NQ. This is NQ. So all this data is about NQ. It's going to apply to ES and CL2, though. So it's just a function of creating the models for those. Most people, that's a good question, Larry. Is everyone with Infinity or not? Most people are with Infinity. Some have other data feeds, and some have both. And there's been some interesting data coming in about different data feeds. So there, you will clearly get different predictions at times with different data feeds. The other thing we noticed is that even on the same transact data feed, when it's really volatile, you'll get different predictions because the incoming data is different. It's coming in too late, and so to the machine it looks different. Under sort of normal conditions, we don't see that. It's pretty much the same. Will a centralized server in Chicago help? No, that's not the issue. The issue is the data coming from the exchange. It's not me. It's not where I'm sitting or where it's where you're sitting, I suppose. But the data is coming from Chicago. And so I don't know if technically speaking, if you're closer to Chicago, it won't take as long, just mechanically, just from the physics. The issue is it's more related to the robustness of the systems that are sitting between the exchange and you. So when you go with someone like Infinity or some other broker and they're providing a data feed to you, these different data feeds have different quality levels. So you can get the gold standard data feed, which is DTNIQ, and pay $95 a month for it. All right, or you can get it for free, And it's one of those cases you get what you pay for. I built the models using the Transact data feed. So when people ask me what should they use, that's what you should use. That's what the models are built on. Okay, last chance for questions before I shut this down, and then it's nose to the grindstone here for the next 10 hours for me. Question from Bill. Let's see. Okay, so basically Bill's asking if the noise filter is a good idea, just based upon, N years of experience doing this. What I see, Bill, is that when the market makes really fast, sharp moves, the noise filter totally fails. But under normal conditions, it works just fine. Because, what you see happen all the time, and I'm sure you've seen it, the market will make a move, and then it goes sideways for a bit while the market digests that move. All right, and when you see when that happens, we want to stay out, right? We want to wait till the market decides to move again. All right, what we've seen in the current volatility is that move is so quick that it takes time for the moving average to catch up, and that's why it's been a little bit uglier. The one question I have that that is on the list that we need to experiment with is, what about breakouts? Do we want to have breakouts ignore the noise filter? Okay, there's a very easy way to test that if somebody wants to do it. Run. Actually, you're gonna, I have to do it because I'm the only one with the data. Is run the system for breakouts only with the normal noise filter, and then run it without it, breakouts only, and see what the results are, and it'll very clearly tell you. So, Michael, the suggestion you're making is the kind of thing that I want you to be able to do, which is why we talked about that roadmap. I don't want to have to deal with the 15 different ways that people have to filter out trades. Oh, okay, Russ, that's good. How would this work with Sierra chart on a non-infinity platform? Keith, my suggestion would be you need to load it up and run a replay and see. It's not clear to me what the difference in the data will be over the long haul. All right, so let's say you're running the Transact feed, which the system's been trained on, and you're running Rhythmic or CQG, okay? And on any given day or any given trade, you may find that one works better than the other, but I don't care about that. This is not, we're not in a deterministic environment, it's probabilistic. So the model is built with the data relating to itself. It's not built with absolute numbers. And so I'm relating the bid volume to the ask volume. And I'm relating that volume in the current bar to that volume in the current wave, to that volume in the previous wave. And so there's never a point where, if Infinity is filtering the data differently than CQG, then because of that filtering, the absolute difference between those two values will have an impact on the model, because the model's comparing itself to itself. So I don't have any data to answer your question. What I want to do, I just haven't gotten there yet. What I want to do is just go buy one of these data feeds, load it up, and see. All right? See what the differences are, how bad it is. All right? Or how good it is. I don't know. I can't tell yet. My expectation is that it evens out over time because of the non-deterministic nature of the environment that we're in, because of the probabilistic nature. But that doesn't mean I'm correct. All right, when I ran, just because I think so doesn't mean it's true. I would have sworn that the test with the noise filter would not have done as better as it did. and yet it was almost double. So you just, you need data. Get the data and make a decision. And I don't have the data yet. Okay, so Bill, yeah, why 89, basically why 89. Well, that's, we've used that number in the past, so that's just experience. 89 is some fib number, it's some Fibonacci number. I don't think it would matter. 80 or 90 or 100, about there is the answer, somewhere in there. It's a question of just how, what would be interesting would be to change it, cut it in half, change it to 45. And see, that's going to be a lot noisier, right? Change it to double it, change it to 180, and see what you get. It's going to be quieter, right? I don't have time for that right now. So Keith has both rhythmic and transacted, and he's got days where one does better than the other, and vice versa. So, all right. I mean, if you don't want to use the noise filter, just set it to 0, Larry. It's still there. That's what's nice about that particular filter is if you just set it to 0, then it'll just always evaluate to true, which means always take the trade. So that's a very clean implementation, by the way, and you can adjust that. You can adjust that yourself. You have complete control over that because you can say how much noise I'm willing to deal with and how long a moving average I'm willing to use. So you can play with that to your heart's content. No data yet on whether it's worth more money to get a higher quality data feed, Randy. I haven't done it yet. It's just planned. I just don't have time right now. Okay, that's it, gang. I'm going to shut it down now and get to work here on this week's release. It's a big release, so there's a fair amount to do. All right, appreciate your time, and I'll see you on Monday morning. I'll send an email out to all members when the release goes up. Okay, it won't be until rats. When will it be? I'm going to try to do tomorrow morning, but I may not make it. It may not be till tomorrow afternoon. Okay. We'll see. My son's soccer is in the way, and I'm now the chief referee. Okay. Take care. I'll see you soon.